Hello everyone. In the series of profitability analysis, we have seen about the profit and loss statement, what are different elements of the profit and loss statement, and we have also discussed about the many ratios and how, like, as a financial manager or financial analyst or as a investor or as a business owner, how you can use those profitability elements and different ratios, how you can analyze it, interpret for your respective purposes and utilize it. In this video series, now we are going to discuss about the balance sheet, like what is balance sheet, how do we prepare, what are different elements in the balance sheet, and how do we analyze those different elements of balance sheet. And as an investor, as a financial manager or CFO, or as a business owner, how we can utilize and get an interpretation for our basically the next actions in terms of our business, right? So let's understand about the balance sheet in today's video. Yeah, so here I have drawn a very simple balance sheet format which we are going to discuss. But more importantly, I'm going to explain you with some very basic examples so that it is very clear to you what is a balance sheet and how it is made. Yeah. So let's understand. So before we go into that, so let's quickly understand, like, what does balance sheet show, right? So balance sheet is a part of the financial statement which shows the financial position of a company. It shows the financial position of a company at a specific point of time. It shows the financial position of a company at a specific point of time. When we discussed about the profit and loss statement, see, profit and loss statement contains all the income, revenue, and the expense. Okay, and the net result is the profits, the final profit which are available for the shareholders or the equity owners, right? So it shows the profitability of the company. So P&L shows the profitability of the company, and also that profitability is shown for a period. So it shows the profitability for 1 year or for 1 quarter or for 1 month probably, right? So it shows for a period what's the profitability of the company. Whereas balance sheet, it shows the data at a specific point of time, at a specific day. Okay, it shows the data not for a complete period. It shows at a specific point of time, right? And it shows the financial position. So it does not deal with the profitability, it deals about the financial position. That means it includes the liabilities, equities, and assets. So that's what it shows. Okay, now let's understand from a very simple example, like how it is made or what do we understand basically from the balance sheet, right? So in order to understand that, let me give you an example. Let's say if you are going to start a business. Yeah, let's say if you are going to start a business, so in order to start a business, what would you need? You would need money, right? Now, how are you going to get that money? So there are two things, right? Since you are starting the business, and for starting the business you need money. So one is like, either you will invest money by yourself, right? Or you will take a loan. You will get money from your friends, or you will get money from the bank. So you will take a loan. There are two sources basically. Either you put yourself some money, or you get it from somewhere. So if you put somewhere, like if you put by yourself, let's say $10,000 you have put by yourself, right? And the $5,000 you have taken on loan, right? Let's say this is the case. So total $15,000 you have invested, 10,000 by your own, 5,000 from your own. So whatever you have invested by yourself, right? Whatever amount you have invested from your pocket, that is called capital. That is called capital. Okay, and whatever amount that is used by taking the loan, right? Whatever amount that is put in a business through the loan, that is called debt. Okay, so since it's a loan which is taken, right? So it's a liability, right? Because you need to pay it back, right? Business need to pay it back. So it's a liability. So there are two things. One is the capital, one is the loan or liability. So capital is something, whatever the owner is investing, whatever the owner putting the money themselves, that is called capital. And whatever is taken as a loan from someone else, that is loan, debt or liability, basically you can say. So 15,000, with 15,000 you have started, some by taking a loan, some by investing your own money. So now what you are going to do with this 15,000? So since I am starting a business, so I need to buy some assets, right? Maybe I need to buy a machinery, right? So let's say $5,000 I have bought a machinery, okay? And in order to utilize that machinery, I need to buy some goods or material, right? So let's say 3,000 is the goods or inventory, I would say inventory or goods we have bought, okay? So 15,000 I invested, okay? 5,000 bought machinery, 3,000, so remaining 7,000 is still with me as a cash, right? So you see, 15,000 was investment, and this is the breakup or how those were utilized. So 5,000 machinery, 3,000 inventory or goods, 7,000 cash. So this is total 15,000. So see, this side is showing basically the assets, right? All my asset, machinery, inventory or cash. And this side is basically showing equity and liability. It is showing equity and liability. So this side and this side both are balanced, right? 15,000 I invested, and this is how I utilize them, right? So now what happens is basically in accounting it's double entry system, right? Each transaction have two sides of impact. One is debit, one is credit, and both debit and credit are balanced. So that's why all your trial balance has to be balanced, and ultimately your balance sheet also need to be balanced, right? So since each transaction has a double entry impact, debit and credit, so all our financial statement, like especially basically the trial balance is always balanced, debit and credit. Balance sheet also is balanced, because this side is basically liability and equity, means credit, it is represented by credit, and assets generally debit, so this side is represented by debit. So liquidity and liability is equal to asset, and that's how it is balanced, okay? Clear? So now take this example a bit further. Let's take it a bit further. So what happens, like this 3,000 is the inventory. Let's say you have sold that inventory, okay? Now you have sold it for 5,000. Now you have sold it for 5,000. Now how have you sold it? Whether you may have sold it on cash, okay, you have sold it and you got it cash, or maybe you sold it on credit. If you have sold it on credit, then you must be having some debtors, right? So let's say if you have sold it on credit, so now in the balance sheet this inventory would be gone, right? Because inventory is not there anymore. Now you have sold whatever the inventory you had. Now you have the debtors, so now that will be replaced by the debtors. So now this side has become 17,000, right? Earlier you had inventory of 3,000 which you sold in 5,000, right? So here 5,000 debtors are there, this side became 17,000. So now it's not balanced. Why? There is one element missing. And what's that element? That element is the profit. So now what happened? Your material cost or your inventory was 3,000, but you have sold it on 5,000, right? So basically you have received the profit of 2,000. There's a profit of 2,000. Now generally what happens, you prepare the profit and loss statement. So before preparing the balance sheet, ideally the profit and loss statement should be prepared first. P&L should be first. And if you had prepared the dividend, so prepared the P&L, so our sales would be 5,000, our COGS would be 3,000, so 2,000 would be final profit, considering there are no other expenses in this case. So this 2,000 profit, actually what happens, so the balance of the profit and loss account, right, balance of the profit and loss statement gets added to the owner's equity. So it will be added here as retained earning. So whatever the balance is there in the profit and loss, the final profit or loss, that is basically for the equity shareholder, basically for the owners, right? So that share of profit or loss, whatever it may be, gets adjusted here in the owners shareholders funds, right? So it will be depicted, or it will be shown as the retained earnings. So in this case, since we had a profit of 2,000, that will be added here as a retained earning. So that's how this side also will be balanced. So 70,000 here, 70,000 here. So this is how, like, the sample balance sheet is prepared, right? So you know what money you have invested, right, or what money you have borrowed on one side. Other side would be how those money was utilized, where it is invested in, right. So this is how it will show the financial position of a company. Yeah. Now, how this element or how these different things are mapped in this structure. Okay, so now let's try to understand this structure, which is like very common format for the balance sheet. Yeah. So it has one side is asset, other side is liabilities and equity. So this side is asset and this side is liabilities and equity. Asset, basically, if I just say like what is asset, asset is something which you own, or asset is something which business owns, right. They own it and they are expected to generate some value. Using those assets, there will be some value generated, there will be some financial benefit will be there for the company, right. So that is what the assets are, where those assets contain some value and it is expected to generate some returns or some value for the company, right. Though that is called asset. Liabilities is something which you have to pay, right, which will result in the outflow of funds from business, that is the liability. Equity is basically the capital, right, what are the funds are invested. Since we have taken an example of the individual business, so he has one person has invested money. In case of company, many people invest the money, those are the shareholders, right. Now, so this side is asset. Asset are classified into the non-current asset and current asset. Now let's try to understand first about the current asset. What are the current assets? So current assets are those assets which are convertible into cash, okay, which are convertible into a cash within 1 year. So any asset which can be converted into cash within a period of 1 year, generally it is said 1 year or within one accounting period, if it can be converted into cash, that will be your current asset. So in this case we have debtor, earlier we had inventory, right. So when you talk about debtors, like how much credit you will give them, maybe 30 days, 60 days, 90 days, right. But eventually these will be converted to the cash, right. Similar to the inventory, so inventory you will not intend to keep it for long term, right. You want to sell it quickly and get the money. So inventory, debtors and all which are generally convertible within 1 year, right, are classified under the current asset. So here you'd be putting your debtors, your inventory, any short term investment which you have done, like 3 months FDs, 5 months FDs, 6 months FDs, right, those would be classified under the current asset. Even the cash would be classified under current asset because it's a cash, right. So current asset which are convertible into the cash quickly within 1 year. Non-current asset are the asset which are intended to be used or kept in the business for more than 1 year. Asset which will be kept in the business, will be used in the business for more than 1 year, those are our non-current assets. So here, like in this case, this machinery, right, which you intend to use for more than 1 year or which will be used for more than 1 year, will be classified under non-current asset. So all your machineries, furniture and fixtures, intangible asset, everything is classified under non-current asset which are used for more than 1 year, right. So this is how the assets are mapped. Now liabilities also have a similar classification: current liability, non-current liability, and the same logic. Current liabilities are something which needs to be paid or which will be paid within 1 year. So whatever would be paid within 1 year, that would be current liabilities. So let's say any short-term loan you have taken, right, that will be your current liability. Here we haven't taken the example, but let's say if you, whatever the material or the goods which you have bought, right, if you have bought it on credit, there will be some creditor. So creditor are generally you have to pay within 30 days, 60 days or 90 days, right. So those creditors would be considered as current liabilities, right, which needs to be paid within 1 year. What are non-current liability? Non-current liabilities are something which can be paid after 1 year, which can be paid after 1 year also, right? So your long-term loan, any long-term loan will be coming under this. In this case, let's say this loan, this $5,000 loan which you have taken, let's say it has to be paid after 3 years. So that will be classified long-term loan, will be coming under non-current liabilities, right? So that's the classification. Now the final is the shareholders fund. So basically it will cover your equity share capital and retained earning. So this portion, equity share capital and retained earning, that will be coming here. Yeah. So this is how this balance sheet is structured. This is a very simple format of the balance sheet, and this is a very simple example I have taken just to show you like what are the different elements are there, how those are mapped, what is current asset, non-current asset. So I hope using this example and based on my explanation, like you would be able to understand what is the structure of the balance sheet, right? What are the different elements and how based on our business sense like we can map different elements to the different categories here, right? Guys, if you have any questions, like you can ask me in the comments. Okay, you can put your comments. I will be very happy to answer those comments. And I hope my videos are very useful for you. You must be getting some knowledge from those videos. So if you guys really like my content, then please like and subscribe my channel, and please give me your appreciation or comments or any suggestion even if you have, right? I'll be happy to like hear back from you. So I think that's it for this video, and in the upcoming video we'll discuss about the other elements like what is working capital, which we can derive from this, what is the capital employed, that also we can derive from this, and also we'll discuss about the specific ratios which can be useful while you analyze any balance sheet. Yeah, so tune in for the next videos, and I'll see you in the next videos then. Bye bye.